So for the first time in about 15 years, cash or money market or treasuries or other fixed income may be a viable investment option because of the yields that we're now getting from those asset classes. And you could even call it an asset class to have in the portfolio right now, specifically to kind of offset some of the uncertainties that are kind of swirling around 2022, pending action from the Fed, how far they go with raising interest rates, how long, will they drive us into a deeper economy, or will we come out of this with a soft landing? So typically, if you're looking at fixed income, one of the lowest risk is going to be government bonds or treasuries or TIPS. And typically, if you invest in a short-term treasury, you're going to get a lower yield than if you invest in a long-term treasury. The more time you go out, let's say 10 years or even 30 years, there's more uncertainty that comes into play with that time. So the investor is going to get a risk premium for that investment. But right now, in the environment that we're in, the 2-year treasury is at 4.25, and the longer term treasuries, let's say the 10-year, is about a point lower than that. So it's the opposite of what we typically see, and it can be one of the strongest signals of what may be ahead for the economy and the market, which I'm going to get into in a moment. It's called the inverted yield curve, and on the left here is what your typical yield curve should look like. The shorter the maturity here on the x-axis, the lower that the investor is going to receive in yield. And typically this is what we see when inflation is stable. You get higher yields in the longer maturities because of that risk premium that the investor is taking on. Now, short-term treasuries are much more reactive to interest rates, and the Fed has recently raised interest rates the fastest we've seen in about 3 decades. And right now, the yield curve, this is called inverted, where the short-term yields are higher than the long-term yields. So investors pouring into long-term treasuries to de-risk their portfolios are driving the price of those long-term treasuries up, and thus driving the yields down even to a point where they're lower than the shorter term. Mostly you're looking at the 2 and the 10-year. So looking at short-term treasuries, let's say even a 6-month note or a 2-year treasury may be the place to be right now, because you can get the higher yields with a pretty similar level of risk or even less risk than going into a long-term treasury. But the other reason that you may want to diversify into government fixed income or even money market is this inverted yield curve that we're experiencing right now has historically been one of the best indicators of recession. So this particular chart is going back to the early 1980s, and every kind of shaded gray bar that you see is a recession. So you can see that when we go into the negative territory here, that's the difference between either the 10-year and the 2-year, or the 10-year and the 1-year. Whenever we dip into negative, that's when we're experiencing that phenomena known as the inverted yield curve, which we have right now in late 22, early 2023. You can see that we're pretty deep into it now when compared to some of the other recessions that we've seen. But this has been one of the most accurate, if not the most accurate predictor of a recession that we have. It's accurately predicted all 5 of the last 5 recessions that we had. So it may be a good time because of finally we're seeing some attractive yields, specifically on the shorter term government debt. And we may see some more instability and some more downside in the market, as it certainly looks like we're going into a recession, maybe in late 2022 or early 2023. Of course, the question is, how deep is that recession and how is that going to impact the market? And the answer is it's going to affect different types of stocks or businesses differently. There may be a soft landing for some businesses or some stocks and a pretty hard landing for others. Typically when You see rates increase like this, it's eating away at the profits of financial institutions. But when we go into an economic downturn, a lot of time the defensive stocks can do quite well. So maybe a good time to reposition your portfolio. If anyone would like to talk about specifics, you can certainly reach out to us. But I hope this was helpful to you and gives you some insight on some asset classes that you may want to have in your portfolio now, which are very, very different than what you may have had in your portfolio a year or 2 years ago. All right. Thanks, everyone.